Welcome back to our intermediate financial accounting class. In the last few segments, we've been talking about cash flows. We've done a lot of discussion of the principles and concepts that FASB wants us to understand, what they want us to get out of it, the styles, the methods, the way that we are increasing and improving from the simplified version to the more advanced version. And then we really got to work trying to do a statement of cash flows, walking through the 8 basic steps that help us build an actual formal statement, as opposed to the simplified statement. Up to this point, we've managed to get through almost 5 steps. We did the net change in cash as a check figure. We made our worksheets. We went through the special transactions. We went through the income statement, and we're most of the way through our balance sheet. We've been looking for working capital accounts and other changes that help explain the difference between my accrual information and my cash flow information. And I've also been looking for changes in all of my accounts just to make sure I didn't miss anything when I made my list for step 3 or when I adjusted for non-cash transactions in step 4. So 2 things we're trying to accomplish with this step 5, and we've been doing a pretty good job at it. Again, taking time to figure out the difference between accruals and cash, and then looking for mistakes. So let's jump right back into this. We finished all of our current assets, long-term assets, current liabilities, and some of our long-term liabilities last time. Now let's take a look at the next of these long-term liabilities, and that's our convertible bonds payable. And again, I have a vague memory from doing step 3 that we have accounted for some of this. So let's create a T account and see if we've accounted for all of the change. So this is my convertible bonds payable, and we started at 3 million and we ended at 1.5 million. Those come right from my balance sheet. Now let's take a look at our step 3 numbers and see what, if anything, we've done to convertible bonds. So let's see, I don't see anything about convertible bonds here. I'm starting to become familiar with where the different accounts are as I go through them over and over and over again so I can get faster at it. Dividends payable, I knew I remembered something. There's my convertible bonds for 1.5 million. I don't see anything else on this sheet. I don't see anything else on this sheet that deals with convertible bonds. And I don't see anything else in my last set either. So I just have the one adjustment. It was a drop to the convertible bonds payable, that's a debit, of 1.5 million. And sure enough, that balances it out, so there's no additional cash here either. I've already accounted for the change in the account, and there's no cash. So let's go back to our balance sheet. No additional cash. There we go, cash. My lease obligation, and again, I remember doing something with this one specifically. I remember having to make a T account so I could figure out what my lease was. So let's jump over to step 3. And I kind of scrolled through these at the end, and I left it down here at the very bottom, our last transaction. And sure enough, there's my T account for the lease obligation. So not only have I looked at specific changes in balance sheet effects, I've actually done the T account already. I know its balances. I know I've taken care of all the cash effects. So I'm just done with the leases. Let's see, next is the net pension obligation. Again, I have a memory of doing something with that. So let's take a look at our T account. Net pension obligation, and it started at 40 and it ended at 30. And I seem to remember doing a journal entry about it. So let's go back to step 3. I'm looking at this first set and I don't see anything there. Scroll down, I'm looking for dividends payable, down, I don't see anything there. Looking from here down, don't see anything there yet. But here at the bottom, there it is. Net pension obligation, a decrease of 10,000. It's an obligation, so it's a credit account, so a decrease would be a debit. 10,000, and sure enough, that makes it balance. This is the pension expense entry. And I guess I should make a note down here. I forgot it earlier. This is the conversion of bonds. But let's see, our net pension obligation already balances, so there's no additional cash flow here either. Let me go ahead and mark that on my balance sheet. No additional cash. Next is our asset retirement obligation. And I don't remember doing anything with the ARO when I did my step 3 numbers. We've gone through it several times now. I just don't remember seeing it. And the truth is, we haven't done anything with it in a special transaction, but we did do something with the ARO. Think about that as we build our T account, and hopefully it will come to you. So we began with 250,000, and we ended at 275. And we did do one thing with our ARO, and we've already accounted for it, but it wasn't in step 3, it was actually in step 4. Right here is our accretion expense, and we said this is how we unwind the discount. So we debit an accretion expense to account for recording the ARO at its present value and then slowly building it up till we actually think we'll have to pay out. So we debit accretion expense and we credit the ARO. And that's what we've done with our ARO, is we've started to unwind the discount. That's what FASB calls it, and move it towards what we think we'll actually have to pay as opposed to its present value. So I need to put this into the T account here because I have accounted for this 25 and I know there's no cash there. This is my accretion expense. And with that, this account balances. So there's no additional cash. And that's what I would expect with an ARO that's still being unwound. Right? The whole idea is I unwind it from what I originally recorded it for, its present value when I started the project, and I'm going to slowly amortize it away until I have to start paying it out. So the fact that it's still in that growth phase, going from present value to future value, suggests that I haven't started paying on this yet. Although it's just an indication. It doesn't mean you're not paying and still growing. That gets really exciting, more exciting than we have time for. Let's go ahead and mark that off as no additional cash. Our next line item are deferred taxes. Now, deferred taxes would help us with cash paid for taxes. So even though it's not up in current liabilities, this is going to help us convert from income tax expense to cash paid for taxes. I've done some of that with my taxes payable and ended up not having to pay quite as much as my income tax expense showed, but I do need to see what deferred taxes does to my calculation. And it works just the same as any other liability. If my deferred income taxes go up, so from 75,000 to 122,000, then cash must have gone up. Not because the government sent me a check, but because I'm not sending a check to them. I'm showing income tax expense based on what I think I should have to pay, but I don't have to send a check yet. I'm going to send the check in the future. So I'm recording the expense now and a deferred tax to show that eventually I will have to pay it. So if I'm going to convert from the expense to the cash paid, I'm going to bring out the part that I will pay later on. And someday when I recognize this deferred tax and I reconcile it back to zero and get rid of it, I'll pay the extra taxes, and that's when the cash will actually go out. So just like I did with my current liabilities, I'm going to take the 122 minus the 75. I'm going to get a $47,000 change, and I'm going to put that right here, and I'm going to label it deferred taxes. Now, one little aside here, you'll notice that on some of these, I've used really formal names like cash paid for marketable securities. A lot of the cash flow from operations adjustments don't have formal names. Some of them do, change in interest payable, change in income tax payable. But on some of these, I'm just listing. It's amortization, accretion, bond premium, deferred taxes, etc. The reason for that is convention. We're showing that there's no cash effect there, so we keep it really short and simple, just to signal there's no cash here. We're getting rid of it. Or we're not doing a change in an account. We're accounting for something special, something unique. And that's what we're trying to signal with these short names. So by convention rather than rule, we get some of these really short adjustment names. All right, the last of our long-term liabilities is other long-term liabilities. And I have not done anything with other long-term liabilities. We've gone through step 3 several times. Hopefully you remember as you've scrolled through it, there's nothing in there for other long-term liabilities, nothing at all, which means that we haven't accounted for this difference. We went from $2.5 million in other long-term liabilities, and now we're down to 590,000, and we haven't talked about it at all. That means we missed something. I don't even have to do a T account. I can just tell you I missed something because I haven't seen anything about it at all. What's the most likely explanation? We paid off this debt. So unless I see something later on that suggests that it converted somehow, this must be cash that we paid out, satisfy this long-term obligation. And I need to show this in my worksheets. And the payment of debt, that's a financing activity. So I'm going to put that down here as cash paid on long-term debt. Now, I have made this note assuming that the only logical explanation is that cash went out. If I get into my common stock account and I see a $2 million change, I might think, oh, I must have converted. But unless I see that somewhere, I'm going to assume cash went out. Again, that's the best I can do on a simple example. In reality, I would go find the journal entry that dropped that account, and I would look to see if cash was involved. Here, I can't do that, so I'm making an assumption. It's cash unless I see something to tell me that it isn't cash. Now, we have one last section to talk about with step 5, and that's to go through the stockholders' equity section. Rather than jumping right into that, all of us together, I invite you to go ahead and try it yourself. Do all the calculations, the adjustments, do the T account and check step 3, and see if you can figure out if there's any other cash adjustments that need to be made. Then when we come back in our next segment, we'll walk through it briefly and check your numbers. We'll see you then. Thanks.